See, advanced capital budgeting topics, theoretical impact of a project on market share price. See, of course, if a company invests in a project and if that project is profitable for the company, of course, company's market price of the share would increase. See, market price is dependent on various factors. One of the factors is company's good performance that would drive the shareholders to buy the company shares. Excuse me. And when you show demand for anything, the price, of course, naturally increases for that particular thing. Correct? When you show demand, lot of demand for something, the price rises. That becomes the cause of inflation even. So
Yes,
the value of a share of stock is the present value of its future cash flows. How? See, when you buy a share, you get dividends in the future. Dividend in the first year, dividend in the second year, dividend in the third year. Okay. And you definitely expect a share to give some returns to you. That is why you invest in a company's share. Suppose you expect some X percent as return. So 1 plus X percent you take to discount this future cash flows to get the present value. That gives you the present value of a stock. Okay. So if the present value of future cash flows increases as a result of new project, of course, because when you take a new project, you get a higher cash flow, correct? Am I right? When you take a new project, collectively your project and that project will give you a higher cash flow. So if the present value of future cash flow increases as a result of new project, that means a new project you have taken and you're getting higher cash now. Definitely the in theory or theoretically the stocks market value would also increase. Okay, so the NPV of the project divided by the number of common shares outstanding should provide an estimate of the amount by which the market share uh, price should increase. So what would you do is, when you invest in a new project, you find out the NPV of that project. That NPV divided by the outstanding shares of the company would give you the additional value what what the company shares can add up to. Okay, so please go for this question. So here you can clearly see Lands Inc., a publicly traded manufacturing company, is planning an expansion. The NPV of the project is 15 million. Already you know this, and the NPV has been given to you. Lands has this much shares outstanding, and the current market price of the shares is $10 right now. Assuming the expected cash flows from the project are realized, what would be theoretical impact of the project on Land's share price? So what I need to see is by how much this particular market price is increasing, because they have planned for an expansion, and since they planned for it, they have started a new project, it seems, which is giving them 15 million NPV, $15 million NPV. That $15 million divided by the outstanding shares of the company tells us from that new project how much they have made per share, $3. So $10 already the existing price and $3 out of it of the new project makes the share $13. So increment of $3 you can see from this particular expansion project. Okay, please go for this question. We'll go for the next one. Yeah, that's it. The next one. Done? Shall we move forward? Hello?
yes, sir. Yes, sir.
Yeah, yeah.
Yes, sir.
So yeah, sorry. Hello?
No, sir.
Hello?
We are done. We are
Yeah.
done, sir.
Yeah, so as I said you, there are many factors which drive the share prices up. So those things are given here. What I discussed, the same things are, same factors are given. You can go through this. Now, incremental analysis, a new asset replacing an old asset. That means you want to replace your old asset with a new one. Why you want to do that? Because you think the old asset is inefficient right now, is not giving you like a good produce, or whatever the production, like you are like whatever the production right now you see can be enhanced if you buy a new and a efficient machine. So these two, can any of the factors can be a reason for you to replace your old asset with a new one. Okay, so now incremental, that means incremental cash flows is the factor which you are considering to replace old asset with the new one. So an incremental capital budgeting analysis can help a company decide whether to continue using an old asset or replace it with a newer asset. In essence, company needs to calculate the difference in cash flows between keeping or replacing the older asset. That means if you keep the old asset, what cash inflows you are getting, and what is the cash inflow you will get if you replace the old asset with a new one. In these both things you need to see, and then you need to decide whether you should replace the old one with a new one or not. Okay, of course the new one would be beneficiary for you. That's the reason why you may be considering it. So here, what are the relevant cash flows? The after tax scrap value of the old asset if and when the new asset is purchased. That is the most important factor. So you should see the scrap value of the old asset, what you're getting when you sell it, and then you have to see like when you, that means the after tax salvage value of the old asset. When you want to purchase the new asset, you are considering the salvage value of the old asset. Okay, see, you can sell that asset and get the money and buy the new asset. After tax salvage value of the new asset at the end of its useful life. Difference between the depreciation tax shield for the new asset and the depreciation tax shield for the old during the period when the old asset during the period when the old asset, if kept, would have been depreciated. Of course, see, the tax rates are not stable, the tax rates would change. So previously what was the tax rate and the depreciation tax shield you had, and now the what is the tax rate and depreciation tax shield you have, both the things you need to compare. If the old asset would have had a salvage value at the end of its life if not replaced, that means old asset like may have some scrap value, and if you don't, if you're not planning to replace it, the loss of the after tax salvage value at the end of the old asset's life if it is sold now and the new asset is purchased. So last, this particular factor also you should consider, that if the old asset would have had a salvage value at the end of its life if not replaced. Okay, if you're not thinking to replace it, you want to use it to the last extent, and you want to see what is the scrap value. Loss of after tax salvage value, that means you are going to get a salvage value, of course, and you need to deduct tax for that. You need to pay tax for whatever the income you generate or revenue you generate after selling your asset at the end of old assets life. If it is sold now, that means if you are selling it right now, that future asset, if you are selling it right now and the new asset is purchased, see, while doing the practical question you would understand it even in a better way. And then any difference in after tax operating cash flow that would result from purchase of the new asset. So all these things are factors you need to consider if you want to replace your old asset with a new one. It's a very big question, very crucial question. We need to do this and we need to understand. Okay, so please go for those points of the relevant cash flows and we will discuss this question right now. Okay, let's go for the question and practically understand what these guys are saying. Example of an incremental analysis. Wannabe company is considering replacing an old manually controlled plastic extrusion machine with a computer controlled extrusion machine. Of course, the old one is outdated one and that has to be replaced with a new one. Because new one is more efficient it seems and can save more power or more energy or whatever it is. Okay, give more produce. Management estimates output could be increased. That means they of course have estimated that the output can be increased if they take a new machine, and they could save labor costs. Okay, with the new machine, so that before tax operating cash flow would increase by this much per year. That is what they are expecting, that if they buy a new machine they could increase the cash inflows by 90,000. Wannabe's cost of capital is 12%. See, every project, whatever you are considering to invest, or if you want to buy a new machine, whatever it is, that particular new machine is not going to come for free. It is going to have some cost. Okay, so it definitely would make you to spend something. You have to take a loan or whatever, and you have to incur that cost. Its effective tax rate is this, is what they charge on the incomes, and capital gain taxes 30%. So this is also important, because when you sell the asset, you should pay a capital gain tax. Read the question once, and the data is given. Existing machines original cost, new machines cost, and installation cost for both, freight and insurance on shipment, and salvage value, and straight line depreciation method has to be used. This expected useful life when you purchased it 10 years, and this is 5 years. Okay, please go for this entire data. We'll see the question, how to do this. Okay, let's go into the question. See, this is the table. As you clearly know, this table is what we need to follow to do a NPV question, correct? So here investment they have given 1,65,000. How you got this 1,65,000? Okay, that we need to see first. Fine. Shall we go ahead now? So we have to see the steps. The first step is after tax salvage value of old asset if and when the new asset is purchased. So did they give you the salvage value of old machine? Yes, and new, and if you purchase a new machine, the salvage value of the old machine is 2,000. So let us see the data here. The existing machine's expected useful life at the time of its purchase was 10 years. And it has been in the service for 7 years. This is additional data. I am not creating it. The question says. Why are we considering this particular 7 years? Because after that it will become a scrap. It could be sold now for 5,000. See, please understand all these factors are important. Existing machines expected useful life at the time of its purchase was this, and it has been in service for 7 years. You can sell that after this for 5,000. However, if the older machine is kept, assume, this is an important point, assume that it will not be sold at the end of its expected useful life, which would occur in year 3 of the incremental capital budgeting analysis. What are they saying? What are they saying? Yes, they are saying all these are assumptions. if the older machine is kept, you assume like that it will not be sold at the end of its expected useful life. What is the expected useful life?
10 years.
10
Okay.
years. So if, however, if the older machine is kept, assume that it will not be sold at the end of its expected useful life, which will occur in year 3 of the incremental capital budgeting analysis. Why year 3? Yes. This could give service only for how many years? 7 years,
years.
correct?
7 years. Yes.
Sir.
Then after that you want to replace and take a new machine. Na?
Yes, sir.
Yes.
So they are saying
Yes, sir.
assume, however, if the older machine is kept, assume that it would not be sold at the end of its expected life, which would occur in year 3 of the incremental capital budgeting analysis. They are saying you to assume all this. Assume that it is not sold and at the end of its expected useful life, which would occur in year 3. They are saying to assume like that. I am not saying this, the question is saying this. The data given is all right, but they are saying to assume in this way that you are not going to sell it and its expected useful life is going to be in year 3 of the incremental capital budgeting analysis. That means you are doing a budgeting beforehand and you are putting some assumptions and estimations for that. They are saying instead assume the old machine would continue to be used for current production through year 5 of the incremental capital budgeting analysis. Assume that at the end of year 5 the old machine would be sold for 500. So please read these points. They are saying to make some more assumptions. First assumption is they are saying that if you will sell it today, after 7 years you'll get 5,000. If the older machine is kept, assume that it is not sold at the end of its expected life, which would occur in year 3 of incremental capital budgeting analysis. Instead they are saying again to assume old machine would continue to be used for current production through year 5, okay, of the incremental capital budgeting analysis. Assume that at the end of year 5 the machine would be sold for 500. All these things you just read it. Just give me a second, 2 minutes. You just read it. Okay, now let's go point by point. Okay, if the new machine is purchased, that's what it has been in service. The existing machine's expected useful life at the time of its purchase was 10 years and it has been in service for 7 years. It could be sold now for 5,000. That means when you are selling it, you would buy new machine, correct? Please tell me. Yes? Yes, na? You are replacing the old one with the
Yes,
new one,
sir.
correct?
Yes, sir.
Now, if the new
Yes,
machine is
sir.
purchased, what will be the NPV of the new machine? They are asking. So many points to be considered here. Old machine, we are only focusing on inflows and outflows. Old machine, if you sell for 5,000 now, that will be an inflow, correct? Yes,
Yes, sir.
you are getting 5,000.
5,000.
Machine has been in service for 7 years and then the straight line depreciation has been this much, and with straight line depreciation you are going to see depreciation tax shield. We'll come to that. So straight line depreciation, how? 85,000. How you got 85,000? 80,000 plus the installation cost plus the freight charges, the direct expenses what you incurred for bringing that asset to your factory and making it in ready to use condition. 85,000 divided by 10, and then so this is your 8,500 per year. You're using it for 7 years. So 8,500 into 7 is how much? Please tell me.
59,500.
So 59,500 has been depreciated right now. Okay. Original cost is this. So the tax basis or as per the income tax returns if you file, okay, is how much? 25,500. So how you got 85,000 minus the depreciation. So you got the actual cost of the asset today. Just a second, just a second. So this is what, and the capital loss. See, you sold it for how much? 5,000, na? See what we are considering.
Yes, sir.
If you want to sell it for 5,000 now, you should first see whether you are in profit or loss. Whenever you want to sell an asset, you would see whether you got a profit or loss. So how to know that whether we got a profit or loss? Very simply, you have studied in your BCom or intermediate the depreciation accounting chapter, whereby you take the assets value, you remove the accumulated depreciation, you get the book value of the asset. Okay, anything. This is the value as on today, and you are selling it for 5,000. So 25,500 asset, if you are selling for 5,000, you incur a loss of how much?
20,500.
So this on 20,500 loss, you are not going to pay income tax, but you are going to get a refund, correct? It's a tax saving, na? See, we pay taxes on profits. On losses, do we pay taxes? No, we save it, correct? My
Yes, sir.
God, no one pays taxes on losses. Hello?
Yes, sir.
Hello?
Yes,
Hello.
sir.
Hello.
Are you
Hello.
Yes,
following?
sir.
Yeah.
Hello,
Yes,
sir.
sir.
So, yeah, hello. Yes, Smith. Yes, yes. You're following. So that's great. So 20,500 is the loss. On this 30% taxes you're not going to pay. That's going to be a tax saving. Okay. That is again going to be an inflow for you. And 5,000 you got when you sold it. That's a inflow. So the total inflow from all this assumption is 11,150. Please make a note of this. This one question is equivalent to very good task as on today. So what is your cash inflow? After tax cash inflow from sale of old machine? 11,150. That is what
150.
you thought that if you sell it today, correct? If you sell it today, you're going to get 5,000, you thought it. And you considered everything. That you're going to get plus the cash savings you're doing from your capital loss. That is 6,150.
6,001.
Altogether it is 11,150, correct?
Yes, sir.
Yeah, so now please check it out
Yes, sir.
once, then I'll go for the next one. Any doubts, you can raise it. Yeah. Now let's go ahead. See the depreciation on the old machine. The depreciation on the old machine is this. If you keep it, see, you are considering all the factors. First factor is if you sell it now, what is the inflow? If you keep it, then what? So the depreciation on the old machine, if kept, would be this for the years 1, 2 and 3. And afterward, it would be fully depreciated. Why? Assumptions. So the existing machine expected useful life at the time of its purchase is 10 years and it has been in service for 7 years. Okay. It could be sold now for 5,000. Today, if you want, you can sell it. Okay. However, if the older machine is kept, assume that it will not be sold and end of its expected life would occur in year 3. Is it correct? Please tell me this line. However, if the older machine is kept, assume that it will not be sold at the end of its expected useful life, which would occur in year 3 of the incremental capital budgeting analysis. Correct? So if I keep it, I am assuming the life would come to an end at 3rd year.
Yes, sir.
So
Yes,
the
sir.
depreciation on the old machine if kept would be this much per year during years 1, 2 and 3, and afterward it would be fully depreciated because I don't want to use it. That's it. Since it would continue to be used through years 4 and 5, depreciation on the old machine would be 0 during 4 and 5 years because it is fully depreciated in the year 3. Correct? That is what they're saying. All these are assumptions. Will not be sold at the end of its expected life, which would occur in year 3. So whenever you think that 3rd year is the expected life, after that the asset is of no use, it becomes a scrap, okay, and it is fully depreciated now. And its depreciation would be 0 in the year 4 and 5. Now, annual depreciation on the new machine would be, so if you buy a new machine, see, you are replacing this old one with the new one, na? Okay. So what is the new machine's value? 1,50,000 plus 10,000 plus 5,000, 1,65,000. So we will see what is the depreciation of this machine.
1,65,000.
Yeah. So the old machine, 3rd year it has come to an end, and 4th and 5th year also the depreciation is like almost all not going to happen. Okay. Now let's see the next line. Instead, assume that the old machine would continue to be used for current production through year 5 of incremental capital budgeting analysis. We will see that. So we will see from 5th year, we will see the 5-year depreciation of the new machine is 33,000. Okay, for each of years 1 through 5. So the difference in the annual depreciation if the new machine is purchased would be, suppose the old machine you are using for year 3 and it would be fully depreciated at this juncture, and then 4 and 5 years also the depreciation would be almost 0. So what we are saying is, if we buy a new machine, everything is clearly mentioned here. Instead, assume old machine would continue to be used for current production through year 5 of the incremental capital budgeting process. So here 2 statements are coming into picture. If older machine is kept, assume that it will not be sold at the end of its expected life, which would occur in 3 years of the incremental capital budgeting analysis. And instead they are asking you to assume that the old machine would be continued to be used. Still it will be using, still it will be used, you will be using it still for current production through year 5. So now we are comparing the old machine's depreciation for year 5 and new machine if it is used for year 5. Because we are doing incremental capital budgeting analysis, we have to compare both the cost and both the inflows of both the machines. So like the depreciation for the new machine would be 33,000, old machine would be 8,500. Okay. So first 3 years difference is 33,000 minus 8,500. So difference would be 24,500. Okay. Yes or
Yes,
no?
Yes, sir.
And then the old machine would be having no depreciation because fully it gets depreciated there. And then this 33,000 is the difference, full difference in year 4 and 5. Thus the difference in the depreciation tax shield would be this much. Okay. for first 3 years, and then this much for the years 4 and 5. Please go for this point. This one problem is a big one. Okay, so now we will put all the things in the table. So depreciation, difference in the depreciation tax shield, because it is an incremental capital budgeting project. So differences is what matter for us. So also from the old machine sale, after tax cash flow we have calculated, and here the differences also we calculated for 3 years and the next 2 years. Okay, so this is all right. I'll go for the next one. So you are considering or planning to take a new machine now, and the new machine cost is 1,65,000. So that I am taking here, correct? Please tell me yes or no. Hello.
Yes, sir.
I want to
Yes,
buy
sir.
the new machine na, for
Yes,
the
sir. Yes,
for
sir.
the next last 5 years. Yeah. So old machine we are replacing. The salvage value of the old machine, if it were kept and used and sold at the end of the year 5, would be 500. That is what they have given. See, assume that at the end of year 5, the old machine could be sold for 500. That is what is again an assumption. So like that is what, and you have to just deduct the tax from it. So the net cash inflow would be how much? Correct? Hello?
Yes, sir.
See, when you sell it,
Yes,
you will
sir.
be getting 500. Okay. So salvage value of old machine, if it were kept and used and sold at the end of year 5, would be 500. Old machine would be fully depreciated for tax purposes, and like you are from the sale you are getting 500. So you deduct the tax, and 350 is what you have. Now this 350 will be negative cash flow if in the year 5 of the incremental analysis, because it represents a cash flow that would not be received in year 5 if new machine is purchased, correct? If you purchase new machine, this you would not get, because it is a
Yes, sir.
replacement. Now it is a replacement.
Yes, sir.
Yes, sir.
So the expected salvage value at the end of the old machine's expected life in year 3 2000 is irrelevant to this analysis, because the old machine would not be sold at year 3 regardless of which option is chosen. We will continue that for the next 2 years, because after in the 5th year we are going to replace it with a new machine. Okay. And what is the increment you are expecting from the usage of new machine? You are expecting some increment in the cash inflows, correct? Of how much? 90,000, isn't it
90,000.
so? Yeah.
Yes.
So after tax deduction, it will be around 54,000. We would deduct 30% tax, would take 70% of it. Yeah, I think. What is that tax given? 40, 30.
40, I think. It's
Yeah.
40.
Okay. So there are two taxes in this question. For salvage value, or that means when you sell the asset, you incur capital gain tax. When you get some income, that is taxable at 40%. These are two different taxes. In India also we have capital gain for assets. Whenever you sell it, if you have a long-term capital gain, you have a 20% tax rate, and for incomes we have a different tax rate. So operating income is taxed at 40%, and this is 54,000 is the cash inflow which you're going to get when you use new machine. Okay, that is what it starts. You start receiving that here, and the after tax cash flow not received from old machine is how much? 350 negative cash flow. Okay, correct
Yes.
or wrong?
Correct, sir.
Yeah, that is again there, which you will not receive because you are replacing old machine. You will just be giving this amount to the guy from whom you are going to take the new machine. That is just a adjustment kind of thing. Okay. Acha. And then again some assumptions were given to you. All this is assumption question. That's why they have complicated this. So now they said that the new machine expected salvage value, and they said something now. New machine, something they said in the beginning. Okay, they are assuming here. New machine can be sold for 10,000 at the end of its life in year 5. So at that point, the tax basis will be 0. So because it is the end of that particular asset's life. Okay. So the amount of gain will be full 10,000, and that should be taxed. Okay. So 3,000 would be removed, and you'll get this much from the sale of that machine. And then after getting all these inflows, you need to add up these figures. Okay, adjust them, and then you get this once, and then you discount it with 12% your cost of capital. You get the discounted cash inflows. Add up all this last ones, remove this. If you get a positive NPV, this replacement project is a fruitful project for you. Okay, just go for this question. I'm waiting. Solve it, solve it. Done? Hello. Finished? Hello.
No, sir. Just 2 minutes.
Okay, okay.
The 2 minutes, sir.
Yeah, yeah, yeah. Please take it.
Done, sir. Hello.
Yes, yes.
Yes, sir. Done.
Yeah, yeah. Just a second.
Done.
Now what we can do is just a second. We have one big question, then almost all this is done for us. Then there are good questions. Okay. Tomorrow, I think these 2 days or 2 classes, more 2 classes, would bring this chapter to an end. Okay. Most probably last 3 classes. So it's the biggest chapter of this book actually. So what we can do is, okay. So now today I'm not explaining you that question because it would take time, but I'm explaining something to you. Please understand. I'm explaining this topic to you called capital budgeting and inflation. See, inflation, is a very like very crucial thing to study for economists as well as investors as well as the companies, managers, etc. Why this is a crucial thing to study? Because whatever the returns you expect from a project, one of the factors to be considered for those returns, what you're expecting is inflation. Why? Because if you don't take inflation into consideration, okay, then the returns what you are expecting in the future, for example, if you're expecting the inflation to be 10% higher and the inflation is going to be, suppose, see, these are just my figures, 14%, then will you be happy? Will you be happy? Because the returns what you're getting, okay, are not enough because the inflation is more than the returns what you're expecting.
Yes, sir.
If you get 10 rupees and the things are costlier by 14 rupees, this 10 rupees you'll be completely spending and 4 rupees additional you're going to spend, correct?
Yes, sir.
Am I right?
Yes, sir.
That is what happens in the inflated economy. If you get less returns in a highly inflated economy, those returns would not be enough for you to buy things when your investment gets matured. Because the return what you're expecting is, you're investing 100 rupees. The returns you're expecting is 10 rupees, but the inflation in the market is of 14%. That means 4% additional cost you have to incur for anything what you're going to buy after 5 years. So after 5 years, you get 10 rupees for your investment and things are at the rate of 14 rupees, for example, if you want to buy something. So you need to pay 4 rupees extra for that because of this inflation factor. So now, whenever you like invest in a long-term investment, in your expected returns, inflation should also be a factor to be considered. That means you can demand like a higher return, because in long term, in inflation definitely can have an impact on your investment, because the inflation has never gone anywhere. It is there, it would be there, and it is existing, prevailing. Okay, so when you expect returns after from some project which is a long project or a long-term project, probably of 10 or 20 years, in your expected returns or whatever the required rate of return, if you are considering, you add inflation also to that required rate of return, so that because of this particular inflation risk, you should be compensated with a greater premium from that project. Okay, then you would be satisfied. Zarina, did you follow what I said?
Yes,
Hello,
sir.
did you follow it, Zarina?
Yes, sir.
Hello. Yes, sir.
Yeah, yeah.
Yes,
See,
yes, sir.
anywhere, if anything, if you're not getting, please raise the doubt, please raise a point, or please ask your doubts. Okay, I make sure
Yes.
that whatever I explain you should be in the simplest form. But if anything is there, please ask me. And now I'm coming into these two concepts of nominal returns and real returns. See, I'll write a formula. Real rate or real return plus inflation is equal to nominal rate or nominal return. If you subtract, see, real rate is always, or return is always considered in a short term investment. Nominal returns you should always expect from long term investments. That means if you're investing in a investment option, and if you're investing for long term, you should always ask the company to give you nominal rate of returns, which already incorporates inflation. That means inflation factor is considered in this particular return. Okay, did you understand what I'm saying? It incorporates inflation. Real rate is without inflation. Okay, that means if I subtract inflation from nominal rate, what I get? Please tell me. If I subtract this inflation, if I take it there, what am I left over with? Please tell me.
Return rate of
Real rate.
yes, sir.
Got it?
Yes, sir.
Yeah. Zarina, did you
Are
understand?
real return. Real return.
Yeah. So when you remove the inflation from nominal rate, you get real rate.
Yes, sir.
When you add inflation to nominal
Yes, sir.
rate,
Yes.
real rate is nominal rate.
Yes,
Okay.
sir.
So now instead of addition, so suppose if my real rate of return is my nominal rate of return is 7%, real rate of return is 5%. So 2% should be inflation. 7% minus 2% is 5%. That is nothing but my real rate. Okay. So nominal, real, inflation, and here like nominal minus inflation is equal to, instead of addition and subtraction, let's come to our old concept of compounding and discounting. So real expected cash flow is always nominal cash flow by the discounting, by nominal cash flow discounted with the inflation rate which you have considered in your project. So you get this. Actually, the nominal rate what you have expected is 11,000 because there you have considered inflation as a factor. Okay, that means your real rate happened to be 10,784. You thought that the inflation is going to be 2%. So 1 plus the inflation 1 plus 0.02. So that is 10,784 into 1.02 and whole power 1 for 1 year has given you 11,000. Correct? Please tell me yes or no. Yes?
Yes, sir. Yes, sir.
So your real cash flow compounded with inflation rate gives you 11,000 and your real cash flow compounded with inflation gives you nominal cash flow. Nominal cash flow discounted with inflation gives you real cash flow. Okay. For 2 years it is this much. That means today something which is of 10,784 is going to become 11,000 after 1 year because of the inflation. And today something is 10,573 is going to become 11,000 after 2 years because of inflation. So real rate of return is equal to 1 plus nominal rate by inflation minus 1. Okay. Like you can see 1 minus nominal rate minus 1 minus inflation rate. This cancel. So nominal rate minus inflation rate is nothing but real rate. Okay. So what I gave you was the same thing. Calculate this and also have a look at this. Then we'll go forward. Okay, done. Okay, so till here you can follow. Tomorrow we'll move forward and cover up that particular four. You have 4 methods in that question. So that those 4 methods we will do in that question. We will wind up that one and also then we'll come to this and move forward with some more questions in this. As I said, more 2 classes would be deciding factor for this chapter. Then we can go with the fresh topic. Okay, we'll start a new chapter there. We'll do 3 or 4 chapters in reporting back to back, or we'll start with variance analysis. Anything like we would try to cover up. Okay, sure. Thank you.